Welcome back to Morning Markets on Wednesday, the 29th of September. Looking first at equity markets, yesterday we had a bit of a pullback in the UK, FTSE 100 off around 0.6%, S&P 500 in the US down around 2%, Europe off around 1%, and in Asia a little bit more mixed, but Japan down around 2%. In bond markets, looking at UK 10-year government gilts, they were up 4 basis points to 0.99%, and in the US the 10-year Treasury yield was at 1.51%, so up 5 basis points. In terms of currency markets, the dollar was slightly stronger, with the Dixie index measuring against a basket of international currencies sat at 93.7, so up around 0.4% the dollar. In terms of sterling against the dollar, 135 sterling against the euro, 116. So sterling was slightly weaker on the days as supply chain challenges within the fuel industry continue to weigh on investor sentiment around UK economic growth. Commodity markets, you had a bit of a weaker price in terms of gold. Gold was off around 0.9%, and Brent crude, in terms of the oil markets, that was down around 1.4%. Yesterday, we experienced a modest pullback, therefore, in equity and bond markets, and a pickup in the implied volatility, with the VIX index on the equity side moving from 13.5 to 17, and on the bond side, the MOVE index, measuring implied volatility, moved from 44.1 to 46.4. On the bond side, this was more notable within government bonds, where Treasury yields on 10-year bonds moved up that 5 basis points higher. In the UK, 10-year gilts moved 4 basis points higher as the market turned its attention back to the inflation debate, given the backdrop of pressures within energy supply chains and the narrative from the Federal Reserve last week that they were approaching the point at which they would look to start to withdraw the emergency stimulus package. In addition to the Fed development, at this point the debt ceiling impasse is also in close focus, with estimates the Treasury could run up to their debt limits by the 18th of October if that limit is not increased, as it has been many times in the past. Janet Yellen, the Secretary of the US Treasury, is pushing for the agreement to be made as soon as possible, so not to lead to a deterioration in financial conditions, which could in turn undermine consumer and business confidence. Whilst the Fed have been clear that they intend to wind back the asset purchase programme before raising rates, here in the UK, Bank of England Governor Andrew Bailey said on Monday that interest rates could rise as early as this year, even before the current bond buying programme expires, if necessary, to manage inflationary pressures, leading to a bit of some of those moves which we saw within the gilt market yesterday. Whilst in the developed world, we're discussing monetary policy tapering across in China, the People's Bank of China are back with monetary easing. Overnight, the PBOC injected a total of 100 billion renminbi via 14-day reverse repos at an interest rate of around 2.35%, marking the 9th straight day of cash injections into the financial system. The central bank reinforced the move's aim to maintain liquidity in the banking system ahead of national holidays, but also there to support financial conditions and limit some of the contagion and sentiment challenges around the ongoing Evergrande situation. Thank you for watching. We look forward to bringing you up to date tomorrow here on Morning Markets.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.